Foreign exchange or FX exposure arises when a company conducts business in multiple currencies. This exposure can impact the company's financial position due to fluctuating exchange rates. One of the main sources of FX exposure is from the balance sheet, which includes a company's assets and liabilities denominated in currencies other than its functional currency. For example, a US-based company may own accounts receivable in euros or have loans payable in yen. When exchange rates fluctuate, the value of these assets or liabilities changes, creating FX risks. Companies typically categorize FX exposure as long or short. A long position is simply from assets in foreign currencies. A strengthening of the foreign currency would benefit from a long position as its assets would increase in value. Conversely, a short position is from liabilities in foreign currencies. A depreciation in the foreign currency benefits the company because the value of its liabilities decreases. Balance sheet FX exposure can significantly impact earnings, which is a key concern for most public companies. Managing FX exposure helps companies present stable earnings, protect earnings per share, and avoid breaching debt covenants. Let's look into accounting details. According to ASC 830, the US accounting standard governing foreign currency matters, companies must account for the effects of exchange rate fluctuations on monetary assets and liabilities, such as cash, receivables, and payables that are denominated in foreign currencies. This process is called remeasurement. When these balance sheet items are remeasured at each reporting period using the current exchange rate, changes in the exchange rate between the foreign currency and the entity's functional currency create gains or losses in net income. It can be before or after operating income or both. Now we understand how balance sheet FX exposure can bring unwanted volatility in your net income. Let's look at what the most common tool to manage this risk: FX forward contract, which is an agreement between two parties to buy or sell a currency at a specified rate on a future date. When using financial tools such as forward contract to address FX risks for various reasons, and tax may be the biggest one would like to create it at the legal entity level where corresponding FX risk resides. After that, it is a good practice to consolidate FX contracts from legal entity level into enterprise level to improve operation efficiency and reduce costs. We are going to demonstrate how to do it using AI automation. The first step is to scan the balance sheet. Most accounting ERP systems are able to define general ledger accounts that are subject to balance sheet remeasurement. All automated FX hedging programs need to scan or download those GL accounts data one way or another. For demonstration, I've created a dummy company that has 10 legal entities around the world. Those entities have their own functional currencies and all kinds of transaction activities, internal and external. Those transactions were randomized by date, amount, counterparty name, currency, etc., by the power of an Excel GPT. The transactions, if not settled, remain on balance sheets such as trade receivable and payable, intercompany receivable and payables, external debt, payable, etc. I chose to generate all transactions for the whole year of 2024. Let's suppose today is March 1st, 2024, and today is the day the company decides to start hedging its balance sheet. Obviously, those transactions after March 1st are unknown. What we know are transactions happened on and before March 1st. Now let's ask the Excel GPT to aggregate all balance sheet exposure into one place. Then we ask it to collapse transaction level data to exposure level data, meaning under one legal entity, each currency has one exposure amount at the most. Here is how it looks. Now we know our exposure amounts and their currencies at legal entity level. Time to create forward contract to hedge the risk. Here we need to detour a bit to find FX rates to be used in forward contract. It is typically ERP system job to download rates periodically. I am doing it now with the help from AI, just to demonstrate how natural it is to talk to machine for certain tasks, which take times to build a model and is prone to mistakes if done manually. I go to European Central Bank's portal to download today's rates. Please note the rates in the list are all against euro and therefore is one dimension. But what we need is a matrix of rates that every possible combination of two has a value. In this rate matrix, the upper triangle is the inverse of the lower triangle because they are used in either sell or buy a currency. Once we have the rate matrix, we can start creating forward contracts. If the exposure is in long position, we need sell this currency against entity's functional currency. Conversely, if the exposure is in short position, We need buy this currency against entity's functional currency. Let's further assume the predetermined enterprise-wise FX forward contract settlement date is June 15th, 2024. In addition, for simplicity reason, let's use today's spot rate to create forward contract. This is only practical for internal transactions. If legal entity has to face external counterparty for forward contract, it will be the forward rate from the market. After internal hedging transaction are created, a good practice is double-checking if combining the forward contracts, the balance sheet exposure has been eliminated. Here, every forward contract is split into two positions. Buy currency is a long position and sell currency is a short position. Here you can see all the exposures are eliminated to zero. In practice, company can set a threshold of hedging, meaning any exposure below that threshold is considered de minimis. Company should try its best to have an in-house bank to centralized FX hedging activities. That's why the hedging transaction previously created were all internal. Suppose those internal FX contracts were created between legal entities and the in-house bank entity that has USD as its functional currency. Let's study what the in-house bank entity needs to hedge externally. We take the same internal FX forward contracts list and split every contract into two positions. One is long, the buy currency, the other is short, the sell currency. Then consolidate them to have a buy currency summary to get the exposure list created by internal hedging transactions. The final step is to create external forward contract with banks. There are many trading platforms such as FXall and Bloomberg. Here is just simplified illustrations using spot rates. Now, let's assume the company has a monthly balance sheet hedging program. Fast forwarding to April 1st, 2024, we need to adjust our hedging positions. Of course, from March 2nd to April 1st, many new transactions happened and many old transactions settled. Let's refresh FX exposures by scanning the balance sheet, which include all transactions happened on or before April 1st, 2024, but yet to be settled, and combine them with positions from outstanding FX forward contracts. Remember, all FX forward contracts had June 15th as their settlement date, so all of them are to be included. Similarly, create the new FX rate matrix based on new download from ECB, and based on the combined FX exposure, create internal FX forward contracts maturing on the same June 15th, double-checking to see if remaining exposure is de minimis. Finally, consolidate internal FX contracts to determine what to do externally with banks for the in-house bank entity. In the example above, I illustrated how to create an automated balance sheet FX hedging program and adjust hedging positions on a monthly basis. In real life, many companies choose to run hedging program more frequently if accounting uses daily FX rates for recording transactions. People have full discretion to determine enterprise-wide settlement day. Typically, it depends on the workload of your back office. You probably would like to avoid month beginning and month end. The time gap between two adjacent settlement days is a balance of internal administrative burden and external credit charges to bank. They start to charge you for contracts staying outstanding for too long, say 12 months. A step called roll forward is needed days before the settlement day. It is to extend the expiration of all existing hedging position to the next settlement day. This is also a good opportunity to consolidate hedging contracts. I used to write an Excel macro for this task, but it would be easier in AI tool or Alteryx nowadays. Their learning curves are much friendly to people who don't have programming background. This hedging program is designed on a method where underlying exposures term is totally irrelevant to determine the tenor of FX forward contracts. In the step of discovering exposure, only currency and amount are taken into consideration. Creation or removal of underlying exposure is captured in the step of discovering the incremental change of exposures when hedging position is adjusted periodically. People with acquisitive minds may notice that this hedging program doesn't discern different kinds of underlying exposure, meaning if a legal entity has $100 trade payable and $1,000 debt payable, it hedges the $1,100 short position in aggregate. This could concern tax because in tax world, gains and loss from derivatives can have different tax treatment when their underlying exposures are different. Another occasion is when legal entities hedges disregarded payable or receivable. Those transactions don't exist in the eyes of a tax accountant, but the GAAP accountant will tell you they do. Therefore, the ability to be laser-focused on transaction level becomes a more realistic request lately. It is very challenging for traditional ERP system where AI and tools alike have a clear edge over them. There are two types of systems in the market that can perform automated balance sheet hedging. The first type is embedded in the accounting system itself. The other type works as an extension package attached to the accounting system, so why bother? Why AI? I believe AI wins in two areas: learning curve and transparency. AI as a tool can be mastered so long as you can speak in natural language. Instead of waiting for months for an expert to program codes for specific system, anyone from a treasury team with reasonable level of hedging experience can do the same with AI with less time and cost. In addition, the business logic is in plain language. The intermediate results are all available. The visibility and control in detailed level of graduality gives extra confidence. My friend, what do you think? Please leave your comment.